I think we should start in a minute or so.
Margot, just to make sure that I pronounce your name correctly, it's Margot Brandenburg, right?
Yes, perfect.
Okay, perfect. Thank
And
you.
Kariman, so I'll wait. You'll introduce me and signal when I should
Yeah,
get going. Perfect.
yes. Okay, I think we're good to go. Good afternoon, good evening, good morning, wherever you are. Welcome to the Gerhard Center webinar series, The Aftermath of COVID-19, the New Social Impact Ecosystem. Today, the 57th session, Impact Investment and Inclusive Capital Market. And we are very pleased and honored to have a very special guest speaker, Margot Brandenburg. Thank you, Margot, for joining us today. We really appreciate you making the time.
Thank you so much.
Sure.
Over to me, or I didn't mean to interrupt you. I apologize.
No, not at all, not at all. Before I leave the floor to Margot to start her talk, let me first give you a very brief introduction about her. Margot is a senior program officer on the foundation's mission investment team from the Ford Foundations, focused on building and strengthening the infrastructure of impact investment market with an eye to shaping the broader capital market. Margot has spent 2 decades working at the intersection of philanthropy, capital markets, and social and environmental justice. Prior to joining Ford, Margot served as founder and CEO of My Strong Home, a benefit corporation delivering resilience finance services to homeowners across the Southeast and Gulf Coast of the US. Before that, she helped design and lead the impact investment and led the impact investing initiative at the Rockefeller Foundation. She co-authored the book, The Power of Impact Investing, with the former RF president, Judith Rodin. While at Rockefeller, she also focused on job creation and the issue of economic security for low-wage workers. Margot began her career in international microfinance and has worked with several community development finance institutions in the US. She serves on the board of Workers Lab, Brooklyn Cooperative Credit Union, and the Woodcock Foundation, and as an advisor to the National Domestic Workers Alliance, as well as the National Energy Improvement Fund. Thank you so much, Margot. Again, the floor is yours.
Thank you so much, Kariman and Dr. Ali, and to the Gerhard Center for having me today. Ford is so proud to partner with the center, and I'm so excited. I apologize for interrupting you earlier. Let me see if I can share my slides with everyone. Are these visible? Good. Okay, I'm getting a thumbs up. Well, again, thank you. My name is Margot Brandenburg, coming to you from New York City. And I represent the Ford Foundation, which is the largest social justice foundation in the world and the second largest foundation in the United States. There's some, words on the screen to describe our mission, but I think, it can be summed up by saying that our mission is really to address and mitigate inequality in all of its forms. There's some statistics, at the bottom. Our headquarters is in New York City, and we have 10 offices around the world, including one in Cairo. And my part of Ford is unique for our foundation, and I think it's unique for the philanthropic sector overall. I sit as part of the mission investments team, which includes an allocation of money from our endowment, $1 billion to be specific. It includes what's called a sort of a program-related investment or a catalytic investment portfolio, and it includes a grant portfolio. So we use, tools sort of across the toolkit, which allows us, I think, to be nimble and capital efficient, because any investment we make out of our endowment, for example, is money that doesn't take away from our grant making. And in fact, as we make money on those investments, it fuels further grant making. Excuse me. So, and out of our endowment, I think it's worth mentioning the sort of 5 areas where our investments focus. We invest in affordable housing in the United States. We invest in biotech and healthcare solutions in the global South. We invest globally in diverse managers with a gender, ethnic, and racial diversity. Financial inclusion, mostly in the global South. And quality jobs, which has a particular focus on the United States. And I would just add, I guess, before I go on, whatever it is, $1.3 billion is large for the field of philanthropy, but we know that it's a drop in the ocean of the capital markets. And so in addition to deploying our own capital, we have a very explicit field building remit, which is to try and grow the field of impact investing, which I'll talk about in a minute, and to really try to crowd in other and hopefully larger sources of capital for the things that we care about. So both our mission-related investments that are made out of our endowment and our program-related investments that are made on the sort of program side of the house, there are 2 types of what you could describe generally as impact investments. And a lot of you, if not all of you, probably know the term, but I'll put it on the slide, and I'm particularly borrowing from something called the Global Impact Investing Network. Impact investments are investments made with intent to generate a positive social and environmental impact alongside a financial return. And so I think helpful to put a point in a couple of parts of this definition. One is that intentionality to create positive impact. And as evidence of that, we look to impact investors to have some sort of measurement tool in place, right? To know that the impact that they intended to have is actually having. And at the same time, we're not talking about grant dollars. There's a whole field that can be described as venture philanthropy, and this is not that. So impact investments also seek to get money back, and it could range from just recovering your principal to a sort of quote-unquote risk-adjusted market rate return. So different levels of return, different asset classes, but all with the shared goal of getting your capital back and proactively and intentionally solving a social or environmental problem. And so I think I mentioned, at Ford, we set out not only to make impact investments, but to grow the field and to make sure that impact investing, which we see as a tool to help us solve the large, thorny, expensive problems that we care about, we want to grow that field with integrity. And, I worked on a research report 10 years ago with a team at JP Morgan and at the Global Impact Investing Network. And we estimated that by 2020, the size of the impact investing industry globally would be between 400 billion and $1 trillion. And last year, I should say at the time, in 2010, when the term impact investing had just been coined, the reaction we got was largely that this was just sort of laughably ambitious, right? Like, no one had ever heard of this thing, impact investing, and we were saying it could be as big as $1 trillion within a decade. As it turns out, the term, I think, caught on faster and more broadly than we could have expected. And so the Global Impact Investing Network, or the GIN, does an annual survey of global impact investing activity. And last year, their survey found $715 billion in impact investing assets under management. So right in the sort of range that we'd speculated, which never happens with these market sizing estimates. So feel sort of proud and lucky about that. But that $715 billion, I think, is worth considering in context, because if you compare it to the availability of philanthropy, for example, it's large. If you compare it to the size of the global capital markets overall, which is $120, $140 trillion, it's still a drop in the ocean, or at least, a very small part of those broader markets. And we at Ford realized that impact investing is a tool, but almost more so the way that we practice capitalism more broadly is either a headwind or a tailwind for everything else that we care about, right? Meaning it can either accelerate or impede all of the other programmatic goals that we have. And so we've started with some intention, not only to try and grow the impact investing space, but more broadly to try and achieve a more inclusive and sustainable form of capitalism, which again is in the category of things that is so ambitious you almost want to laugh. But given the scale and the urgency of our problems, we feel like it's something that we absolutely need to try and take on. And I would say the thing that gives me hope that we have some shot at success is that there has been significant growth in what is called sustainable or responsible investing, right? And so in these little circles that you see, the blue circle is the estimated size of the sustainable investing market. It's now a third of assets under management in the US, and a lot of estimates believe it'll be a third or more of global assets within the next couple of years. And I'll say more in a minute about what that is, but I think it's potentially positioned as a bridge between this, dedicated intentionality to have impact that we see in impact investing and the rest of the capital markets, which is generally agnostic or even hostile to the shared prosperity that we want to see. So here, I don't know if this slide is going to make things more or less confusing. But this is a slide that was developed by the consulting firm Bridgespan to try and explain how these different types of capital relate to one another. And so on the bottom axis, you see, approaches to impact. And on the left-hand axis, you see expected financial return or profitability. And so that, the left top corner is traditional investing, right? You make as much money as you can within your risk profile, and you have no regard for the impact that you're creating. Traditional philanthropy is the bottom right corner, where you're entirely motivated by the intent to have an impact, and you're expecting negative 100% return on your investment, right? You're typically not expecting to get any of it back. And so those, at least in the US, there's been a very bifurcated approach, and I think in many places around the world, to profit maximization on the one hand, pure philanthropy or charity on the other hand. What you see kind of across the top of this graph are the different shades of gray in between. And so that top right corner is where you would put impact investing, right? That has high intent and a range of financial returns, but all kind of north of philanthropy, because as we said, you're expecting something back. And then, more in the kind of passive category are the things that are described as responsible investing or sustainable investing. And these are things like a stock fund that has been screened from tobacco or from coal, or a green bond. So it's less probably intentional and less focused on management of impact, but still, expecting or focused, I should say, on something other than the financial performance. And so this is another kind of common way that we see investors try to organize their approach to their capital. It's developed by something called the Impact Management Project, which is based in the UK. And so you'll hear now a lot of investors talk about the ABCs, where A is acting to avoid harm, right? So this is those traditional screened funds that I mentioned, cutting out fossil fuels or something like that. Benefit stakeholders is a more of sort of a generalized way of saying, I want my investments to do as much good as they can. So whether that's fair trade or, making sure that there's, human rights compliance in our supply chain. I want sort of all the best practices to be there in my selection of investments. And then C would be contributing to solutions. So that's where I want to, invest in a company that is selling off-grid home-scale solar to people that are without energy in parts of the world. Or I want to make mortgages to, first-time homeowners in communities that have typically been disinvested by banks. And so increasingly, I think you'll hear investors talk about organizing their investments into A, B, and C categories, which has been a step forward for the field because previously these things all get kind of conflated together. So here again, just a sort of a summary of how capital flows. And this I should say was developed to describe impact investing, but it really describes any part of the capital markets. At the top you have asset owners. So a foundation like Ford would be an investor, pension funds, insurance companies, sovereign wealth funds, individuals. They rarely, if ever, invest directly into companies or projects. There's almost always, particularly for larger investors, this layer of fund managers or asset managers. And so capital flows, from investors through managers, in some cases, a few layers of managers, down to the company or project level. And so on the right hand, you'll see sort of how that intentionality can flow. And often, particularly outside the US, more so than in the US, you'll hear investors talk about their intentions using the Sustainable Development Goals and framing their investment thesis in terms of those SDGs. They then expect their asset managers to implement those goals and to report on it. And so those managers will collect data from their portfolio companies or projects. And I listed here a few approaches: IRIS Plus, the B Impact Assessment, the Global Reporting Initiative, that are really intended to track performance and outcomes related to those stated impacts. This is just, to sort of level set about how capital and how impact is meant to flow. And so we talked about, that there has been really steady year-on-year growth over the past decade, both in impact investing and in sustainable or responsible finance. And I will say, surprising to a lot of people is that acceleration has happened almost more so in the past year. When the economy globally really started to falter in March, I guess, of 2020, there was a lot of speculation that both impact investing and then even just these basic sort of responsible and sustainable investment parameters would all kind of fall by the wayside, and that investors would be quick to sacrifice them when they got nervous about their returns. And in fact, what we've seen is quite different than that. I think if anything, there's been an acceleration. So, steady growth, including in the past year. And Dr. Ali had just asked, for some thoughts on the qualitative nature of how things have evolved. And so I offer a few thoughts. One is that COVID and the racial justice uprisings that it started in the US and have happened around the world, I think have really made more prominent the S, or the social, in environmental, social, and governance factors. And for a long time, particularly in the sort of more mainstream parts of these industries, climate and climate change was the motivation that drove particularly larger pools of capital. And as a social justice foundation, Ford has always been eager to make sure that S, whether that's labor rights, human rights, gender and racial equity, that those S dimensions, get the attention that they deserve. And I would say the pandemic and the focus on systemic racism has really laid that bare to a much larger number of people. And so you see, an increasing focus on that S, which, is progress as far as we're concerned. Policy and regulation are really emerging as drivers. The European Union is poised to issue pretty robust requirements around non-financial performance disclosure that will apply to large as well as to small companies. And IFRS, which is the accounting standard used in 140 countries, basically everywhere but the US, they announced at the end of last year the creation of a sustainability standards board, which will codify a set of environmental and social performance metrics that will sit alongside financial accounting metrics. And so taken together, I think those signal a really strong role for policy and regulation in driving these broader capital markets forward. The US, China, other major regulatory bodies almost certainly will follow suit. And a big question is whether we can achieve some kind of harmonization globally between regulatory bodies, or whether this becomes fragmented and then left to companies and investors to navigate the regulations from different jurisdictions. But net, that policy is really going to set a floor for reporting on and therefore managing non-financial performance is it's a big deal, and it's something that a lot of Ford's grantees have worked hard to bring about. We're seeing, I think, still a generational shift in expectations of capital. I advise a number of family foundations where it's typically the younger generation of trustee, I think similarly for family businesses, that's thinking about impact, and that expects that the place that they work for, the things they invest in, either express their values or at a minimum are not in conflict with those values. And again, that's something that I think as money is inherited by younger generations, that set of expectations is only going to become more explicit. At the same time, I think philanthropists who want to give back and might have only seen charity as the tool for doing that are now seeing their investments as a tool. And so here in the US, there's a number of foundations that have been set up recently as LLCs rather than private foundations. And we can debate sort of the different reasons, but one of the reasons is certainly to have more flexibility, to be able to invest, for example, in companies that might be contributing to the impact that you want to see in the world, and not only relying on grants to have an impact and to achieve your programmatic or your social goals. More broadly in the capital markets, we see, per these trends, a big increase in green bond and social bond issuances. So Ford last year, given the crisis facing the nonprofit sector, we issued a bond, a $1 billion bond, to be able to double our grant making over a 2-year period. And it was rated by the credit rating agencies, Moody's and S&P, but it was also rated by a firm called Sustainalytics as a social bond. 30 and 50-year bonds, so really long-term bonds. And, there's no counterfactual, so it's impossible to know for sure, but the bankers who assisted us with that transaction believe that having a social bond designation reduced our cost of capital, so allowed us to issue bonds at a lower rate than we would have ordinarily had to pay. And we hear that over and over, whereas a few years ago, a city or a company issuing a green bond or a social bond was told not to expect that they would get any preferential pricing. We're seeing now commonly, 30, 40 basis points even of discount from having a social or green bond. And I think that's a reflection of how much, ESG investment activity there is in the markets. Also, I think worth noting that we're seeing a sort of a new vanguard of shareholder engagement. Historically, there was some religious groups and some other relatively small investors that would file resolutions at companies and have had some great success. But typically, shareholder engagement is not a tool that impact investors or even, really advanced sustainability investors think a lot about. And this season in 2021, we've seen some really forward-looking activity at the annual meetings of companies. And just last week, there's an ESG hedge fund for good called Engine Number One that removed several of the directors at a company called ExxonMobil because they weren't embracing the transition to a low carbon future. And so this sort of typical fairly aggressive tool of an activist hedge fund is being replicated, in this case for environmental impact. So in the big company space, we're seeing, more kind of edgy and interesting tactics that I think are worth keeping an eye on. And then, the G7 currently hosted by the UK has a sort of another task force focused on impact investing as well. So another way for government to sort of understand what they can do to accelerate these developments even further. And, I was cautioned not to make everything seem perfect, and it's harder to find people that talk about what makes them nervous or what might not go well. And so I wanted to flag a few things that I see as potential risks. And of course, you can turn a risk into an opportunity as well. Listed here are a number of the mainstream asset managers that have launched impact funds over the past couple of years. And in some cases, these are multi-billion-dollar funds, which on the one hand is, a great indication of progress because we need, billions and then trillions of dollars to do things like provide affordable, adequate housing and to provide healthcare to everyone who needs it. But, you hear often people either privately or less privately worry about greenwashing. And the thing that I worry about is that as these gigantic asset managers launch an impact fund, that is a distraction for all the other practices that this investment firm might employ across the rest of its portfolio, right? And so if all of your societal obligation is channeled into what is big for this industry, but in the scheme of things, a rounding error on your balance sheet, you can easily imagine that the net negative would outweigh the positive. And so one of the things that we look for, that I look for, particularly when you see a mainstream fund launching an impact fund, is how is that fund being positioned to inform practices across the larger portfolio of that asset manager? Like, are you going to learn from this impact fund, and what will it take for you to extend some of those practices or those investments more broadly to your, to the rest of your portfolio? I think another risk, is that this rising interest in ESG and environmental, social, and governance, it gets conflated with impact investing. And so these non-financial disclosure regulations and policy developments that I mentioned is a good example. Let's say there's 12 environmental and social factors that all companies have to report on sooner rather than later. That's the floor. but it shouldn't be the ceiling. And so as ESG comes mainstream, we need to make sure that those leading edge of impact investors are pushing further, faster, right? And really getting toward active impact management in a way that is, going to be far beyond whatever regulation requires as a minimum. I think I mentioned I do worry that as Europe and the US and as accounting bodies develop their own disclosure requirements, that those get fragmented, and then we have a hard time comparing a French company to a Chinese company to an American company, and there's a history of not harmonizing standards that I think is worrisome and something to keep an eye on. Different risk. I think we see a lot of innovation at the business model level, a lot of entrepreneurs with talent and passion and able to attract capital, but those investment mechanisms haven't received as much innovation as the business models themselves. So you'll see the sort of 2 in 20 model of an investment fund in private equity or venture is fully replicated in the impact space, which in some cases might be perfectly fine, but I think constrains what is possible with impact. And then, writ large, the thing that worries me most as a parent of children is that there's lots of good things happening and none of it happens fast enough, right? That the scale, but really the urgency of our problems risk dwarfing all the good progress that's happening because it's not enough soon enough. And finally, maybe just a couple of thoughts on sort of how this varies by region, and then I'll stop and hopefully we can have a conversation. In the United States, in particular, over the past year, DEI, which stands for Diversity, Equity, and Inclusion, is an investment thesis and theme that has gotten far more prominent. It's something that Ford has focused on for a number of years. And increasingly, other asset owners and managers come to us and want to learn and want to deploy capital into investors and businesses that are run by women and people of color, who are in turn serving, creating wealth in those communities and serving those needs. So that's a really, I think, important driver of the industry in the US, at least. Policy historically has played a significant role in the development of community development finance institutions, low-income affordable housing, opportunity zones. Policy and regulation has been a big driver here. And foundations have been, and I think continue to be, some of the pioneers and some of the folks that are really testing out models that other and more commercial actors can replicate or can adapt. Europe, again, policy and regulation, huge. Historically, Europe has had the largest sort of sustainable investing market, as some of these, this very narrow focus on profitability has been integrated into a larger sustainability picture for years now, and particularly on climate. We see that as a big driver of what's happening in Europe. In China, my colleagues in Beijing report a significant increase in interest in ESG or sustainable investing. I think my colleagues said as much as $2 trillion of Chinese capital is now looking to be invested sustainably. Again, the E is a significant driver there, particularly given the Chinese government's commitment to going net zero, in a matter of decades. Impact investing still feels unfamiliar and confusing to most of our colleagues in China, and tools for measuring impact, all of the parts of the ecosystem that we know need to be there for the industry to mature and deliver impact are pretty early stages in China. And MENA, relatively nascent industry. I think real variation, as I understand it, in policy and regulation across different country environments and across sectors. I've heard reports that there's often a mismatch between the type of capital that businesses need, particularly in impact business models, and the expectations of investors, that are looking to deploy that capital. But I did find this graph here that summarizes, where there's been sort of year-on-year growth in the past couple of years. And the MENA region, albeit from a very small base, has had the highest growth, I think, between 2014 and 2018. So, maybe the foundation isn't as robust as in other regions, but the growth rate certainly seems to be. And so with that, I think I'll stop. I know I covered a lot of material quickly, but I would love to hear and answer questions or to have a dialogue.
Thank you so much, Margot, for this fascinating presentation. The work that you and your colleagues at the Ford Foundation is doing is really inspiring, and I'm sure the audience have many questions. So please feel free to share your questions in the chat box or raise your hand to engage in the discussion. But before we move to the audience, let me ask you a couple of questions. Actually, I'm very interested to know, how did you start working in impact investing? There should be a story behind that. So if you would like to share it with us, that would be great.
Well, thank you, first of all, for the question. I guess, what is now called gender lens investing, or a focus on women's equality and dignity, was the thing that first motivated me. And I, in school, I had wanted to be a doctor. And then I did a sort of a pre-internship at a hospital and realized that I faint when I see blood. I literally just hit the floor unconscious. And so I realized that being a women's healthcare provider was not going to be my contribution to the cause. But I was living in the time in Senegal, in West Africa, where there's a very long history of credit unions and cooperative financial institutions, and now microfinance institutions. And so I ended up working with actually two different institutions, and had the chance to see sort of up close, what access to fair financial services can do for women who either need to start a business or who maybe just need to pay school fees, and to smooth out those costs through the year, because they can't come up with it in one fell swoop. And so really channeled all that passion into microfinance, where I worked for a number of years, which led to community development finance here in the US. And I arrived at the Rockefeller Foundation at a moment when there had been these successes in microfinance. There'd been some successes in clean tech. And I think people were starting to ask each other, what else could we apply these things to, right? What about education? What about healthcare? What about housing? What about, other aspects of the climate crisis? And at the same time, the Rockefeller Foundation, where I was working, was approaching its 100-year anniversary. And this idea that philanthropy was going to be able to scale solutions, it just didn't hold up anymore. In a previous era, the foundation's assets had been so big, relatively, and now they had, become so finite relatively. And so there was really a focus on what we could do, to leverage in or to crowd other sources of capital to the things that we cared about. And so, hosted a couple of meetings, and this term of impact investing was created, and it's been an exciting past decade to see it take root.
That's very interesting. Thank you so much, Margot. Margot, from your own perspective, what is the role of large companies, the big guys, in impact investing?
Yeah, thank you. I mean, typically, I should have mentioned, a lot of what investors consider impact investments are into private businesses, small and or private companies, sort of not the public markets. And that's for a few reasons, but, essentially the sort of expectation of quarterly earnings reports and all the short-term pressures that public companies face are considered to be such an impediment to really, first of all, long-term value creation, but then, deep impact. But increasingly, I would say we're seeing large companies get involved in different ways. A lot of companies have sort of corporate venture arms, and they're looking at impact investments, in the way that any number of other investors are. We've seen a handful of companies go public as something called a benefit corporation, and in particular, that's happened in the past year. I think the hottest IPO of 2020 in the US was a company called Lemonade, an insurance company that's a benefit corp and a B Corp. And not only are B Corps committing to manage their impact on stakeholders, but they've changed their articles of incorporation to be explicit about creating stakeholder value. And so for many years, people said, well, large investors are never going to go for that. They're going to worry that it's going to come at the expense of long-term shareholder value. And sure enough, we're seeing now public companies IPO or convert to B Corps, which is exciting. And beyond that, supply chain initiatives, focus on employee practices. I think it's no longer true that a company will just make a grant to express its values, right? You see that showing up in a lot of different ways, which I think is really exciting.
Thank you, Margot. We have Ahmed Naguib. Please, please unmute yourself and
hello?
address your question directly to Margot.
Sure, can you hear me?
Yes, perfect.
All right. My name is Ahmed Naguib, and I'm with Finance and Investment Banking Consultants International. Thank you. And I'm a former Ford employee over 20 years ago.
Fantastic. Doubly nice to meet you.
Because I left in 2002, actually. Anyway, so I wanted to ask you, are there any grassroots funds that are started to attract perhaps smaller companies and people to invest in those funds? So the opposite of the question that Kariman just asked you, instead of the big companies, the smaller companies and the everyday lay people.
Yes, so I love the question because, I think it can be said that there's an elite nature to a lot of this, because these investments have only, for the most part, been available to accredited investors or investors that have substantial assets, right? And so how is anyone else supposed to get involved? I think that's your question. And obviously, or not obviously, I think appropriately there's some regulatory scrutiny that makes the bar higher for things that retail investors are going to invest in. My mom asked me about investing part of her 401k retirement plan into something, and I was very risk averse on her behalf in a way that I wouldn't be if I were talking to a pension fund who's in the scheme of things talking about a fraction of their balance sheet. But we have seen, Calvert investment notes in the US really, pioneered this in a lot of ways 15 years ago. And there's been some additional regulatory changes, particularly in the US, that make crowdfunding of equity investments permissible and easier to do. So over the past couple of years, there has been a real increase in the availability of retail investment products. Some are aggregators. So there's one called C-Note here that aggregates investments in community development finance institutions. Calvert, I mentioned, had been doing that in a slightly different way for years before. But a B Corp that I'm associated with, the National Energy Improvement Fund, which is an energy efficiency finance company, they had raised meaningful amounts of equity through a crowdfunding platform. This one is called Raise Green, but there's a number of other ones. And so that's literally, raising equity investments from friends, family, and neighbors, but not only a rich uncle, right? In this case, it was literally like the person down the street, who might have had $1,000 to invest, but not 100 or 100,000 or $1 million. So there's still, I think a lot of room for growth, and certainly some concerns that I mentioned to be cognizant of. But we've definitely seen an increase in the sort of retail product availability over the past few years.
Thank you so much, Margot, and thank you, Ahmed, for the question. Tariq Selim, Dr. Tariq, please.
Hello, everyone. Do you hear me?
Yeah. Yes, we can hear you clearly.
Thank you very much, Margot, for this interesting presentation. And I teach feasibility study at AUC, and one of the criteria for social impact projects that we have is value-added social impact. And my question is that going through the website and going through the projects and your presentation, I see a lot of kind of like relabeling of financial institutions that already existed but have a social dimension, but it's still bottom line financial. So when we're talking about, for example, real estate investments, it's basically bottom line financial, but they are, for example, buying houses from neighborhoods and then renovating them and selling them at much higher prices. So still the drive is still profits. My question is, how can we incorporate with this drive another drive for social impact? Meaning affordable housing, for example. So investing in affordable housing. Or investing in garbage recycling, directly speaking, rather than having an investment of renovating houses, but rather selling affordable housing. They're completely different markets, or they're completely different approaches and different targets. So my question is, how can we accelerate towards the target of social impact, on value-added social impact that is beyond financial? Thank you.
Thank you for the question. You really got at some of the existential questions that I think this whole industry faces. And, there is a tension, I'll just name it, between, a strong focus on profitability and on market rate returns and scale. Right. And so, if you want to tap into some of those tens of trillions of dollars in the capital markets, I think we need to find a way to do that is compatible with I'll call it a reasonable rate of financial return, right? Holding aside whether there's unreasonable expectations that just frankly aren't sustainable across the board. To your particular question around housing, the U.S. in particular, I would say, has benefited from tax incentives and an enabling policy and regulatory environment that really drives capital into affordable housing in a way that it otherwise would have been less likely and maybe wouldn't have done. But we often talk about the returns in our affordable housing portfolio not only in terms of the absolute level of return, but in terms of the risk-adjusted return. And so look at stability, if it's a large multifamily rental building, how likely are you to have turnover, to have consistent on-time payments? And we've made a number of affordable housing investments from our endowment, which is expecting to get the same rate of return as the rest of our endowment. And it's those returns that our grant making depends on. And we've had quite strong financial performance. And that's in large part because of what we perceive to be the attractive risk characteristics of those assets, which is to say that they're less risky than some other, otherwise similar assets. And so if you think that, risk is a big part of the picture, I would say, how do you de-risk investments? How do we use guarantees, whether they're governmental or private? to de-risk investments and unlock more capital than any one of us could do individually. And so Ford and a number of other foundations in the US will participate in sort of these layer cake like finance facilities. Will be the bottom rung, so to speak, the first loss or the risk capital, with that goal of driving more capital, but in exchange, right, like requiring some firm parameters around accessibility, affordability, and quality. And the other thing I'll just say about this, the first part of your question, I think, which is about whether we're just repackaging existing commercial investments and calling them impact. I understand why that concerns people, and I do share the concern, but I think there is a signaling issue or a potential for signaling, which can be helpful if we put it in a longer term context, right? So if asset managers are motivated to look at their current portfolios and try to highlight renewable energy investments that they were making, or investments that have a strong, job quality focus, or into businesses owned by women or people of color, that might not result in any net additionality in that moment. But if what that's doing is conditioning investors and clients to look and to expect those things, then I think over time we're contributing to what is hopefully a paradigm shift, right? Where when someone sends you a deck or an investment summary, they're not only talking about the returns and the profitability, they're talking about these other aspects of performance. And ultimately, I do think we need that system-wide paradigm shift. And so, yeah, I'm probably less bothered by some of the repackaging than friends and colleagues I have. Although I understand why you're concerned, and I think that makes sense.
Thank you so much, Margot, and thank you, Tariq, for the question. Dr. Ali?
Okay, I could follow up with what Tariq was saying. When you look at any investment, there is a life cycle for it. Think of a startup. I mean, when you're starting initially, you're probably going to cough up your own money. Then you're going to go for a university or an incubator, then et cetera, et cetera. So I see when you look at the whole life, the issue of risk or how you to mitigate risk is by using appropriate money. I mean, banks are going to always be conservative, so you give them when there is a clear proof of concept. Philanthropists are always willing to sort of even cough up money with no return, so they are very much good in the initial stages. And I think this is the concept of blended finance, isn't it? Now, my point, and I want to get to it, this is that somebody like a Ford Foundation, he could actually play very strong role in a seed or a catalyst mindset. That if you want to start something, you could actually start it rolling. Now, to do this, you need to sort of have relations or cooperations with other typical investors, whether you call them venture, classical investors, I don't really give a damn. But the idea is that if you do this, why things are slow, because if I'm going to do an idea, I'm spending 70-80% of my time and energy trying to find an appropriate finance. If this is late for me right from the beginning, that will make life easier and will make it much faster. Just wanted to get your opinion about this. Thank you.
Thank you, Dr. Ali. I think you're right. These, the opportunity to have a blended finance facility is a bit what I was trying to get at with this idea of a layer cake, right? That you'd have a tranche of foundation money, and then maybe some government money or some bank money, and you could slot in, high net worth individuals. You could sort of slot in different actors into different tranches in that stack. But some of the most successful, impact investment structures that we've seen do feature those different investors that have different priorities. I'll just say in practice, it's harder and takes longer than it does if you do it alone. And so, I think that's just hard to avoid because inevitably, more people, more competing priorities, the more complexity you introduce. So the hope is that when you do have a layered structure, you can take all the effort that went into it, some might say the brain damage, and amortize that right across other similar vehicles. Like either you grow that vehicle over time, and hopefully the commercial investor realizes that risk mitigant that they needed doesn't actually have to be as robust because the perceived risk was maybe more than the real risk, right? And they get comfortable, whether it's lending to underbanked people, that they can make more investments over time and size down the concessionary part of the capital stack. But in any event, that there's an agreement to sort of do it over and over, so that all the upfront work that went into something, can pay off across, more investments and more impact.
Thank you so much, Margot. Thank you, Dr. Ali. Salvan, please. Okay.
Yes. Thank you, Margot, for your really interesting presentation. And thank you, Professor Ali and the team at the center for the interesting session. This is really really great. So I'm actually I'm coming from the development side with UNDP, and the reason we're really interested in that is that what we realize pretty much everywhere with the type of development challenges we're having, and with a climate catastrophe coming our way, is that all the government budgets in the world and all the even donor money in some countries are not scratching the surface. So we really need this impact investment and impact management to come on top of all the rest, if we want to beginning to meet the challenges. So that's extremely important. And I have to say, I'm really glad that in Egypt it's starting. And we've seen quite a few private equity funds that have, actively declared themselves as impact. And there's quite a lot of other large companies that are going into the habit of reporting impact. But my question is on precisely that, on between measurement and intent. And Margot, you have mentioned that you're coming from the microfinance world, and I've seen that very often, that those who have intent don't really know how to measure, and those who have no real intent have enough funds to use the reporting like GRI in a very narrative way, and being able to demonstrate, quote unquote, impact. And what we're struggling at the moment is really in this weak link that you went over quite fast. You mentioned GRI, you mentioned ISIS, but these are broad methodology. When it comes to actually doing it and being convincing, it's a bit more difficult. So would like to know your views on that.
Thank you, Sylvain, for the question. I mean, it's so important, right? We talk about growing impact investing with integrity, but we can't do that, and we can't know if we're doing it without impact management and measurement. And you're right, not disclosure, which I would say is being transparent about your activities, maybe your outputs, that shouldn't be conflated with outcomes and with these changes in the world and in people's lives that we want to see. And it's a big challenge because actual impact measurement is also quite expensive, right? If I talk to colleagues in evaluation, you need to have, if not a randomized control trial, you need to have a baseline, a comparison group. And so the expense and the time that takes to do well is often considered prohibitive by investors. And some of that is just self-serving, right? People want to move fast and break things and don't want to be constrained. But, I think there's some, I'm sympathetic to the idea that a big academic study attached to any investment is, potentially going to just, be prohibitively expensive and cumbersome. And so, a couple of thoughts on how we kind of move through that challenge. I do think that, an ongoing conversation between academics and between the impact measurement universe of initiatives in Alphabet Soup is important. And so if, what we can hope for is that these outputs, let's say, are proxies or leading indicators of impact, then hopefully we can allocate capital, smartly on the basis of outcomes, knowing that in the background there are those that are testing that hypothesis, right? And really trying to understand if those impacts do correlate with the activities and the outputs that you would hope or that are listed in the deck. So having that sort of strategic connection between academic research and on these sort of like mass produced impact measurement tools is something that I think is important, and there's some good conversations underway and some good I think interlocutors that are making sure that conversation happens. But a couple of other things just to mention, one is the emergence of companies, and there's one called Bluemark that focus on impact assurance. And so, rather than try and test whether an impact thesis and the intended outcomes is there, they will essentially audit the process in place for organizing the activities, for implementing systems to track outcomes. And so, that's a way that a number of investors have tried to maintain integrity without having to focus on long-term impact measurement and the sort of, expense that it takes. And there's other tools, 60 decibels is one, and there are others that focus on beneficiary or constituent voice. And so making sure that there is a way for the individuals who are ultimately intended to be impacted in a good way from these tools, that they have a direct feedback loop, right, to the company and to investors. And so again, that's not a stand-in for sort of rigorous impact, but we think it's important because we think constituent voice is important. And I do think those feedback loops, can help everyone understand what's happening and hopefully iterate much faster so that we can see faster improvements in people's lives.
Thank you so much, Margot. Thank you, Salvan. Margot, can we take one final question if you have time?
Of course. Yes, absolutely.
Perfect. Thank you so much. Vinay Sharma has a very interesting question.
Yes, Margot, it was a great presentation. So my basic question is regarding the metrics, as far as this, impact investing is measured, because there are a lot of conflicts. For example, our opportunity cost involved as far as impact investing is concerned. For example, as far as ESG funds are there, there's a lot of, at the moment, low interest rates as far as Federal Reserve is concerned. There is, and these impact investing research, goals basically like climate, etc. basically need a lot of, time. They might need even decades, and your other investors, for example, the normal investor basically is not that, patient, at any point of time. He basically thinks quarter to quarter, month to month, or sometimes year to year. So how do you deal with such type of, issues in the impact investing? Because impact investing is a lot more, it basically needs a lot more patience, a lot more of, a lot more of, time as far as, returns are concerned, for the society and for the firms and for the individual, So how do you address that?
Yeah, how do we get to this holy grail of patient capital, right? That's able or willing to wait in order to get the return that they seek, but to see the impact realized that they were hoping to have. It's difficult, and the sort of norms and rules that incent and require, quarterly earnings performance and short-termism, those are very difficult to overcome, right? Even when we're talking about a private asset, that isn't participating in those sort of public markets requirements, like you still want to know right away, well, what's happening? What are my returns looking like? And so I would say, in part, that gets back to Dr. Ali's point about the capital stack, right? And whose capital are we talking about, and who can be patient, right? And so, different investors will have different time horizons. If an individual needs their money to send their child to college next year, they shouldn't lock it up in a 15-year, private equity investment, right? They need to keep it liquid. But a pension fund that's managing liabilities 30 or 40 years out, they should be able to be patient, particularly if the sort of like accounting and regulatory environment supports some of that. So I think it's a question of sort of whose capital we're talking about and what constraints and opportunities are available to that capital. I think there's an elusive but really important normative shift, right, that needs to happen, so that investors don't just look in 30 days, 90 days to understand what's happening, right, and to appreciate the time horizon that's involved, particularly in some of these impact investment opportunities. And last thing I'll just say is, and we've been doing some thinking about this, this idea of structuring, right? And can we have an evergreen fund? How do you give liquidity to investors when they need it without requiring that capital, be pulled from the company, or that an asset is entirely refinanced? And so what are opportunities on the structuring side of things? I don't know that this gets at your sort of quarterly horizon short-termism issue, but I think it can get at some of the real sort of liquidity requirements that certain investors have. And there's some interesting, innovations happening to try and match investors and create, longer-term horizons that can work for everybody, or work for more investors, I should say.
Thank you so much, Margot. Thank you, Vinat. Thank you, Margot, for your time and for a fascinating presentation. We really enjoyed it a lot. Thank you so much.
Thank you for having me, and I'm happy if anyone wants to reach out on LinkedIn or by email. I'd be happy to continue the conversation with anybody. So thank you for having me.
Thank you. And thank you. Big thanks to the audience for your participation and the great question. And the conversation is still going. So please join us on Monday, June 7th at 7 p.m. Cairo time. We are hosting Jacqueline Novogratz. She's the founder and the CEO of Acumen. She will lead the conversation around market, social change, creative finance, and moral leadership. So thank you so much. Thank you. Margot, enjoy the rest of the day.
Have a great evening. Take care, everybody.
Bye.
Bye-bye.
Thank you, Margot. It's been fantastic. Bye.